welcome to this ASI webinar on the Chain of Custody Standard, where we do a step-by-step walk through the Chain of Custody Standard. I am Krista West, Director of Learning here at ASI, and in this webinar we will be looking at Principles 3 to 8 of the COC Standard on identifying COC material and eligible scrap in the mass balance system, as well as Principle 11 on market credits. Viewers should have a sense of how to identify ASI COC versus non-COC material inputs, and how to account for inputs and outputs within the certification scope using the mass balance accounting. Viewers should also come away with an understanding of how ASI market credits can be used within and between organizations, and how credits impact the claims which a certified entity can make. As we do at the start of each session, I would like to remind all viewers of the ASI antitrust policy. If you are not familiar with this policy, I direct you to the Legal Policies and Finances section of the ASI website under the About ASI tab, where you can download a copy of the policy to review. Also, at that website, you can find a short webinar which addresses the critical points of this policy. As discussed in other webinars, ASI's certification program covers the entire aluminium supply chain. There are performance criteria for specific supply chain activities under the ASI Performance Standard. The ASI Chain of Custody Standard then connects performance with the flow of material under a mass balance or credits model. There are 7 defined stages in the COC system: bauxite mining, alumina refining, aluminium smelting, post-cast house production, which includes semi-fabrication and material conversion facilities, and then the remelting and refining of scrap. We will refer to these 7 stages throughout this webinar. ASI requires that every COC certified entity track material inputs. All material inputs are designated as either COC material or non-COC material. COC material is a collective term for ASI bauxite, ASI alumina, ASI liquid metal, ASI cold metal, ASI aluminium, and eligible scrap. ASI bauxite is bauxite that is produced from Performance Standard certified bauxite mines that are either within the entity's COC certification scope or the COC certification scope of another certified entity. Similarly, ASI alumina is alumina that's produced from Performance Standard certified alumina refineries that are either within the entity's COC certification scope or the COC certification scope of another certified entity. ASI liquid and cold metal can come from 2 different sources. It can either be produced from Performance Standard certified smelters that are within the entity's COC certification scope or the COC certification scope of another certified entity, or it may be produced from Performance Standard certified remelters and refiners that are either within the entity's COC certification scope or within the certification scope of another COC certified entity. Eligible scrap may come from multiple sources. Firstly, it may be pre-consumer scrap that's been supplied directly from a COC certified entity. Alternatively, it could be aluminium that's recovered from dross and dross residue, or post-consumer scrap that has been subject to due diligence under Principle 7. The last type of COC material input is ASI aluminium. ASI aluminium is produced from a Performance Standard certified cast house or a post-cast house facility within the entity's COC certification scope or within the COC certification scope of another certified entity. Another way of looking at this is that there are 3 different paths by which material can be designated as ASI COC material. Firstly, material that is generated internally to the entity's COC certification scope is designated as ASI COC material through the entity's material accounting system. Internally generated material includes material which is produced within the certification scope, such as ASI bauxite or ASI alumina, and may also include any scrap that is generated internally through the manufacturing processes. The second pathway is ASI COC material, including pre-consumer scrap, that is produced at the facilities of another COC certified entity, and this may enter the entity's material accounting system through the transfer of COC documentation between the 2 entities. Once a documentation is received, an entity may enter the externally produced material as a COC material input into its mass balance accounting system. It is important to note that pre-consumer scrap may only be designated as ASI COC material if it is generated internally to an entity COC certification scope or within the COC certification scope of another entity. Lastly, any post-consumer scrap can be designated as ASI COC material if it is subject to the due diligence requirements of Principle 7 of the COC standard. As stated earlier, all material must be designated as COC or non-COC. It therefore follows that all material that isn't designated as COC material must be designated as a non-COC material input. This could include bauxite, alumina, liquid or cold metal, or aluminium, which has not been designated COC material. All material which is designated as non-COC material must be subject to due diligence under Principle 7 of the COC standard. Do note that non-COC material inputs do not include non-aluminium materials, such as alloys, carbon, coke, cryolite, or residuals in post-consumer scrap. Another way to look at this same concept, focusing just on the issue of scrap, is with this diagram. Here you can see, of all recyclable scrap material, only the material that is post-consumer waste, subject to due diligence, aluminium recovered from dross and treated dross residues, and COC scrap, that was already COC material, is eligible to be designated as COC material. When accounting for eligible scrap, entities should include only the mass of the aluminium in the scrap material. For example, post-consumer scrap may be a car, which contains aluminium, steel, glass, plastics, and rubber. The car may weigh 1 ton, but the aluminium is only 300 kilograms, for example, so the input into the material accounting system should only be 300 kilograms. This is an extreme example, of course, and the separation is done mostly before it gets to the refiner or remelter. But, say in the case of cans, the mass of the recycled cans sourced by the remelter refiner will include the plastic film, internal liners, the printing, etc. This would be negligible, and the mass of the can bundle would be the mass of the eligible scrap input. And lastly, only aluminium is accounted for in inputs, i.e., alloying elements are not accounted for. However, there are conditions. So alloys within an aluminium content greater than or equal to 90% can be counted as 100% aluminium, so long as the output mass does not exceed the input mass. Alloys with an aluminium content less than 90% should use the actual percentage amount by mass. However, the entity can round up to the nearest 10% amount. For example, an 85% alloy can be accounted for as 90%, so long as the output mass does not exceed the input mass. Due diligence must be applied to suppliers of all non-COC material inputs, including aluminium recovered from DOS and treated DOS residues, and post-consumer recycled material. Due diligence is not applied to suppliers of alloying elements or other inputs. Due diligence is comprised of 3 components: a policy, risk assessment and mitigation, and a complaints mechanism. The due diligence process must take into account 4 policy areas: anti-corruption, responsible sourcing, human rights due diligence, and conflict-affected and high-risk areas. ASI uses a mass balance system which enables the chain of custody program to scale up to achieve impact with less costs and barriers to participation. At the level of a company, the mass balance system is based on a material accounting system, and between companies is based on tracking material through COC documentation. This allows certified and uncertified products to be mixed, while ensuring that the mass of certified material in equals the mass of certified material out. The focus of a mass balance system is on connecting supply chain practices, not aluminium atoms. ASI requires that every COC certified entity create a material accounting system that records input and output quantities of COC material and non-COC material by mass. Remelters must also record the input quantity of post-consumer, pre-consumer, and eligible scrap. The entity may set a material accounting period which is convenient to their business so long as it does not exceed 12 months. All COC certified entities must calculate an input percentage. The input percentage is the amount of COC material plus the amount of eligible scrap times 100 divided by the total amount of material inputs. Material is accounted for using mass. The input percentage determines the possible output quantity of COC material. An output quantity is a subset of the total production and is designated as 100% COC material. What this means is that if a company has 100 tons of output and the output quantity is 50%, then the company has 50 tons of COC material and 50 tons of non-COC material available. What it means is that a company can't sell 100 tons of 50% COC material. Material accounting for defined COC certification scope occurs within a black box. Over the material accounting period, the input percentage of COC material and eligible scrap must be greater than or equal to the proportion of COC quantity output within the black box. There can be mixing of COC and non-COC material at any stage within the black box. So note that COC material inputs can be allocated within the black box without consideration to the physical distribution of the material between the facilities within the certification scope. The black box of the COC certification scope could consist of one site or multiple sites. Logistically, it's the same, as there will be mixing of COC and non-COC material in both cases. For both instances, there is a decoupling of the material accounting of overall inputs and outputs from the actual physical flows of aluminium. Multi-site companies have the opportunity to create an integrated COC certification scope covering a number of facilities that they control, such as a mine, refiner, smelter, casthouse vertical integration, which will allow them to designate inputs and outputs between the facilities, regardless of the physical flow of material. Because the ASI performance standard must be applied to all sites that are within the COC certification scope, this still promotes good practices at all COC certified facilities. Let's look at a vertically integrated primary production company, which, in this model, operates two physically separate streams of material. In Stream A, bauxite is mined at Mine A, shipped to Refiner A for refining, and then to Smelter A for smelting. In Stream B, bauxite is mined at Mine B, shipped to Refiner B, and the alumina is smelted at Smelter B. In this model, there is no physical mixing of the material between Stream A and Stream B. If a company were to certify just the facilities Mine A, Refiner B, and Smelter A, they would be able to designate the outputs from Smelter A as ASI COC material, even though the physical material chain is not continuous through Refiner A. In this case, the black box of the material accounting system tracks the material, and there is no need for an internal material accounting system for each facility. Now let's look at some practical examples. When calculating the amount of COC material, remember that the inputs and outputs are calculated on a proportional percentage basis. So in this example, we have 100 tons of COC aluminium and 50 tons of non-COC aluminium as an input into the certification scope. That gives us an input percentage of 66.6%. Looking at the waste from this certification scope, there are 20 tons of COC aluminium waste and 10 tons of non-COC aluminium waste, and the outputs are 80 tons of COC aluminium and 40 tons of non-COC aluminium. If you have both recycled and virgin material as your material inputs, the calculation is the same. As you can see in the diagram, there is still 100 tons of COC eligible material as an input and therefore the input percentage is 66.6%, and the outputs remain the same. And remember, your input percentage is based solely on your aluminium content, so long as your alloy percentage is less than 10% of the total input. So in this diagram, we have 100 tons of COC aluminium in and 10 tons of alloys. That gives us an input percentage of 100%. In the diagram here, we have 20 tons of COC aluminium waste coming out of the CERT scope and 90 tons of COC aluminium. When your alloy percentage is greater than 10%, your input percentage is rounded up to the nearest 10th percentage. So in this example, there are 90 tons of COC aluminium and 20 tons of alloy as inputs, and therefore the input percentage is 81% rounded up to 90%. This then results in a corresponding material output of 81 tons of aluminium, that's COC material, and 9 tons of non-COC aluminium as an output, and then 18 tons of COC aluminium waste, and 2 tons of non-COC aluminium waste. Another critical component of the ASI certification system to understand are market credits. Under the mass balance system, every step of the supply chain must be COC certified as per the COC standard, and COC material must be transferred from one COC certification scope to the next in an unbroken chain. If there is a break in the chain of COC certified entities, the material cannot be transferred further downstream in the supply chain. Market credits create a mechanism for the accounting of ASI material to pass over uncertified entities in the supply chain. Under the market credit system, credits can be passed from a cast house to any downstream facility post-cast house. If there is a break in the chain of COC certified entities post-cast house, then the COC status of the material may continue in the form of ASI credits and can reach the entity that seeks it. There are several rules that apply specifically to market credits. Market credits may be only transferred once from a cast house to a downstream entity, and they are transferred via digital certificate via the two entities. Entities receiving market credits must use them within the material accounting period in which they are received. And a company receiving market credits may only receive them for a period of 5 years from the date of the first market credit purchase. And lastly, it's important to note that on-product claims cannot be made with market credits that are purchased. Let's put all of these concepts together into the material accounting for one singular COC certification scope. Firstly, on the left-hand side, there are inputs of 50 tons of COC material and 50 tons of non-COC material from outside of the certification scope. This gives the entity an input percentage of 50%. On the first run of calculations, this would result in an output from the remelter refiner of 50 tons of COC material and 50 tons of non-COC material. At the cast house, the entity then sells 20 tons of ASI credits, and this is removed from the supply of available COC material. Thus, there is 30 tons of COC material and 70 tons of non-COC material available from the cast house. Now let's look at the roller. Here, the output quantity of 30% is applied to the material leaving the rolling mill, which results in 30 tons of COC material and 70 tons of non-COC material. Now let's go back to the remelter refiner and look at this again with some internal accounting for waste. In this second iteration, you can see that there are now additional inputs as the internal scrap from the cast house and the rolling mill are accounted for. So the total inputs are 50.6 tons of COC material and 51.4 tons of non-COC material. This adjustment is carried through cast house and onto the rolling mill. And you can see, however, that by the end, all of the additional inputs at the remelter refiner are counted as waste outputs at the cast house and rolling mill, and the total output from the certification scope is still 30 tons of COC material and 70 tons of non-COC material. One question we're often asked is whether a company can get COC certified before they have COC supply. During the early years of COC audits, it's not always possible for companies to have ASI COC material already available before they become certified. In these cases, auditors will want to see that the company can demonstrate that they have the necessary systems in place for when they do receive COC material. For instance, the auditors will look to ensure that there's a material accounting system in place to track COC inputs and outputs, and that the company has the ability to generate COCO documents. The auditors would then later verify these systems in operation at the surveillance audit. Another question that is asked is what are the implications of setting a specific material accounting period? We spoke earlier in this webinar about the material accounting taking place within a material accounting period, but didn't specifically define what a material accounting period is. So to back up a bit, the definition of a material accounting period is the period of time over which COC material inputs and outputs are reconciled over. Some things companies should consider in setting their material accounting period are, firstly, that the maximum material accounting period length is 12 months. Secondly, the material accounting period does not need to follow a calendar year. However, entities should be cognizant of reporting requirements in Criteria 1.7 that requires reporting values of inputs and outputs to ASI on the calendar year cycle. Thirdly, COC material expires if it's not sold in the material accounting period immediately following the period in which it was produced, and therefore the shelf life of COC material is set by the material accounting period. Additionally, ASI credits expire within the period they are received, and so the time period by which credits last is also set by the material accounting period. Lastly, a company can set a material accounting period that predates the issue of its COC certification. However, a performance standard certified entity may not stockpile COC material prior to becoming COC certified, which means that COC material is not created until the COC certificate is issued, even if the material accounting period has already started. And a few last points on the sale of COC material and market credits. The sale of COC material market credits may be backdated within the material accounting period, so long as the transaction does not create an overdraw on the account at the end of the material accounting period. Secondly, the balance of the mass balance account must be greater than or equal to 0 at the end of the material accounting period. However, it may run into a deficit at any point during the material accounting period. And lastly, in situations of force majeure, an overdraw of 20% of the total input quantity is allowed. This overdraw must be replaced at the beginning of the subsequent material accounting period. In this session, we looked at designating COC and non-COC material, the material accounting system, and the details of both the mass balance and the market credit systems. Thank you for tuning into this educational webinar. If you are looking for more information on ASI or any of the topics we've discussed here today, you can either email info@aluminium-stewardship.org or check out our website at www.aluminium-stewardship.org. If you're looking for ongoing updates, please feel free to join our ASI mailing list that you can find also on our website.